Hello traders, and welcome to NOFT's Weekly Market Compass, where we help you navigate the week ahead. Our Weekly Market Compass is brought to you by our head trader Troy, who in between assisting traders in taking the next step in their careers, provides weekly and daily guidance in our live trading room every single day. Before we get into this week's guidance, we need to remind you that trading does carry significant risk, and all information in this video is just provided for educational purposes only and is not an offer or recommendation to trade future stocks, options, or Forex. From everyone here at NOFT, good hunting out there and happy trading. Here's Troy.
Okay, let's take a look at forexfactory.com calendar. Here Monday, March 26th, you can see there are no red events, pretty quiet day. Got a bunch of FOMC members, Fed members speaking. Dudley, Mester, and Quarles all speaking today, different times a day. Maybe they will shed some light on additional easing or tightening, depending on what camp you're from. The rhetoric over the weekend was that there's probably a very, very low probability that they're going to have 4 raises this year. It's probably more going to be in the course of 2, is what I was seeing a lot on Bloomberg and others over the weekend. It's kind of interesting how things change so quickly. But that being said, all orange events, which is medium impact. A couple of things going on in the Aussie land. Royal Bank of Australia, governor speaks, Governor Kent speaks. Not a big impact. So today, I don't really see any kind of news event that's really going to, scheduled news event at least, that's going to affect us. Looking forward into the week, we have on Tuesday, we only have one red event. It's a CB consumer confidence. Obviously, this is a big number because consumers control or impact the U.S. economy in a gigantic way, excess of 70%. Also, I do like the the Richmond Manufacturing Index, which comes out also at 10. Will show some of the more southern manufacturing. Usually, the Richmond Manufacturing Index does better than some of the further north indexes due to the differential in labor costs. So I'm always watching that to see how that fits in with all the other manufacturing indexes from other parts of the country. On Wednesday, we have final GDP. It's a pretty decent number. It's a really big number, but it's also prone to a lot of mistakes. It's very difficult to estimate total GDP. But obviously they're going to do their best, expecting 2.7%. We'll be interested to see how that pans out at 10 o'clock on 10:30 on Wednesdays. Of course, we have the crude oil inventories, that weekly inventory, always nice. I love seeing pending home sales, although it's not nearly as important as permits. We've talked about this before. The majority of homes these days are pre-sold. In other words, they already have a buyer prior to actually starting the home. So starting the home and then a pending sale, you get the idea here. The pending home sales is not a huge number. You probably knew that going in, that the majority of houses that are being built today are pre-sold. So there's not as much speculative housing as there used to be. Part of that is because the building permits are so expensive these days. That's always an interesting number. I do pay attention to that. Yellow across the rest of the board, nothing going on. On Thursday, the 29th, we have a bunch of British numbers coming out. Main one there is the current account. Lots of information there coming out, which will, I assume that we're getting more and more into this Brexit scenario. It seems to be getting a little bit more on the nasty side. Not that it wasn't already, it just seems like we're hearing more nasty stuff coming out. These numbers are going to be important. Obviously, Whether they go through with an exit or what level of exit they go through, I think will depend upon the expected outcome economically. In the end, it all comes down to economics. So we'll see how that develops. 8:30, CAD has a couple of numbers, GDP again, and then the U.S. has some numbers as well, but they're all medium impact, core PCE, personal spending, unemployment claims. All that is going to contribute to the bigger picture as to what's going on in the U.S. economy. 9:45, Chicago PMI, 10 o'clock, revised University of Michigan's consumer sentiment and inflation expectations, all going to sort of set the stage for the what is expected, or at least what is the underlying economy doing with expectations. Not much the rest of the day on Thursday. Also, Friday, of course, is Good Friday, celebrated here in the U.S. The U.S. most major markets will be closed, and you can see that worldwide, German bank holiday, British bank holiday, Canadian bank holiday. Good Friday is celebrated pretty much worldwide, and most of the major markets will be closed on Friday, and we will not be having our standard trading room discussion at all on Friday, so it will be closed on Friday, as well as all classes that NOFT has will also not be taking place on Friday if they are previously scheduled for that. It is a legal holiday here in the U.S. That being said, let's go ahead and jump over and look at some charts. I want to take a look at the ES. We've had some discussion. There's been a lot of discussion over the weekend. I watched not a lot, very busy doing other things, but a lot of people are now discounting the level of sell-off that we have seen due to the perception of it's not about Trump, it's not about the tariffs, it's just about being overextended from a PE. We see a lot of technical analysis people coming in and saying, well, the market's been overvalued, and they keep reminding that it's not that big of a sell-off. So I'm waiting for this to just update here. Expand this out a little bit. I want to in my volume composites just not quite there yet. There we go. You can see that we haven't come down to test these February lows yet, and the understanding is that we probably won't. I'm not sure where they're getting that, because usually if you think a support level is going to hold, what it normally happens is it doesn't hold. But that being said, we still have not yet tested this, basically a 25-30 area. I think we are going to test that area. I think we will break through it. Just a lot of stuff going on to trade, potential currency war, trade wars, tariffs. None of that's good. And I think that the market is slowly starting to see that may be the case. Plus, we are seeing, particularly the FANG, the Facebook, Amazon, Netflix, Google, are trading at unprecedented PE ratios, and that is also contributing to this whole discussion of overvaluation. Whether that is actually the case or not, who knows? But I think that this line in the sand that they've drawn around this 25-30 area is very, very dangerous to be talking about that level. Like, what's going to happen if we break that level? So a little bit concerned about that rhetoric over the weekend. NASDAQ, now this pattern, again, if we can spread this out just a little bit here, notice how we've had this sort of bear flag pattern. We drop down, consolidate, drop down, consolidate, drop down. Yeah, that's exactly what I'm thinking is, yeah, here's, now notice that the size of the flags, certainly, this is very concerning that this big move down is a much bigger flag, or much bigger pole to the flag, which can mean one of two things. We may have finally found a bottom, or this is just the beginning of another larger, more explosive leg to the downside. Some of you Elliott wave people out there will see this as the beginning, and if we get any kind of little bounce in here, that it will be further sell-off is certainly in the picture if you're an Elliott wave person. Jumping over to the NASDAQ, we have obviously I've got some data missing here, but we've got, you know, a very, very similar flagging pattern. Obviously this needs to be pulled down like that. Yeah, you get the idea here. The NASDAQ, I think, is more vulnerable than the S&P, simply because the companies are obviously not as big, and they certainly are more not as diversified within in that group. So I think the NASDAQ could fall substantially more than the S&P. I think that some of the flight to quality will happen eventually in the S&P, and that will not be part of the NASDAQ scenario. In the short run, let's go back to the ES. What are we looking for? I would be shorting into this 2650 area right in here. Let's see. Put a band in there. Why is that going to do? Yeah. So this, oops. Well, that area needs to be moved. I need to move that up just a hair. It's not letting me grab that line. We can do that though. Line, here's one line. No. Below, that's what I need to do right there. There we go. Right in here. In the middle of that is 2655. That is where I would be aggressively looking to short. Long, I would wait till it comes and retest this 2591, but very, very cautious there. I think the risk is definitely to the downside in the ES. The NQ, similar, very, very similar scenario. If we scrunch this up, it's got a little bit farther to go before we hit those February lows that we saw. So it's not quite as bad a shape as the ES, but this thing can move in a hurry. You can see some very, very large candles back here in February that would very, very quickly close the differential between here and this February 9 low. So charts are looking kind of nasty, and certainly the risk is definitely to the downside. I don't see these bottoms as potential buy spots. I see them as just maybe a scalp trade here or there, but I think there's a lot of risk down here that it's going to continue to break. The Russell, man, what's wrong with my data today? Russell has been the weakest of the group, and you can see that when the NASDAQ was hitting new highs up in here, and so was the ES, we were not doing that in the Russell here. Russell has taken a lot longer to recover, and I say by far the weakest of the group is the Russell. Although we do have quite a ways it hit to come all the way back to the February lows here. This chart actually looks a little bit better than all three. We definitely have some intermediate support areas that are just non-existent on the other two. So kind of interesting there. Looking at crude, jumping over to crude, we have retested the highs of 166.60 area. Again, I think that this is completely dollar denominated. Lower dollar has created this situation. And a little bit of fear is coming in. Again, when fear comes into the market, where do you go? You go to physicals, something I can grab and hold and tangible. And so oil is one of those, and I think this run-up has been related to the tariff situation as well as the dollar demise. So that's the situation there with crude. Definitely interested in reshorting if it can come up to this area here. Remember that crude oil, the supply and demand has just not been manifesting what the true price should be. There's just too much fear. Also, you got some Saudi Arabia stuff coming into the mix here today or over the weekend with the Yemen insurgents, I guess is what they're calling them, sending ballistic missiles into Saudi Arabia. That's going to definitely intensify over the next foreseeable future. Could also be affecting oil here. So more geopolitical stuff than actually supply and demand related. Of course, everybody in the U.S. In the oil patch is cheering on any kind of geopolitical stuff so they can turn on the pumps. So I think what's going to end up happening is that the overall market share is going to shift. The U.S. will just turn up turn on the pump a little bit more, turn the faucet on, and provide. There'll be just less coming from Saudi Arabia because it just, let's face it, you don't have any shipping costs. It's already here, so it's cheaper, certainly cheaper to get to the end source than having to ship product in from outside the U.S. So I think Canada, the U.S. are just going to increase supply here at these prices, which eventually will cause the price of oil to come down, minus the geopolitical risks. So that's my 2 cents worth on oil. I would short it around the 66.60 area. Long-wise, I think there's a lot of risks to be long. Again, that's because the supply and demand matrix just is not matching where price should be. So I would be taking shorts when appropriate, not taking longs in oil. Gold, again, we're getting this dollar. The dollar is contributing to this. Obviously, there's some geopolitical strife. We could easily see this thing retest into the 1365, 60, 65 area back up here. Very, very strong move. Actually, it's a very strong move. Very little pullback. These pullbacks are very, very short that we have had. Gold is sort of signaling that, hey, there's still a lot more momentum here, and could definitely see. I don't know if you want to call this a three-leg move. I'm not sure it's all. I see it as maybe one move, but even if you are looking at a three-leg move, that puts it back up here, testing the highs of 1370. ZN is continuing to go sideways, and I expect it to go sideways to up as the dollar continues to deteriorate. It shouldn't. It should go sideways to down because the Fed is projecting that it's going to raise rates. However, like I said earlier, over the weekend, a lot more people are saying that the Fed may not have, may be unable to fulfill 4 hikes this year. And so that is in question. So we could definitely see some volatility. I would say the risk here is to the upside, not to the downside. So I'd be careful about shorting the ZN in this particular instance, at least at this point in time. One little quick look at Bitcoin. This just looks like we're going to roll over here. We may find support at this tail here. I think we're just seeing the slow demise of fiat currency, if we can even call it that. At least most fiat currencies are backed by a government, and the Bitcoin's not backed by anything. So it's fun to look at. What can I say?